I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik. He's the president of InsideTrack.com. Welcome back to the show, Eric.
Oh, thanks for having me back, Jim. Good to be here.
Crude oil churned around in the plus 50 mark for the longest time. Now it's into the upper 40s. What's the story on crude?
Well, it's kind of the same thing that I've been saying since 2015, 2016, and that was that I thought we'd see a major multi-year bottom come into play between December 2015 and January 2016. That was linked to a lot of longer-term cycles. It was an exact 7-year cycle from the previous bottom. It was an exact 17-year cycle from the lowest point. And so from a broad-based perspective, that remains the overall cyclic outlook. But as I was telling you back in early 2016, I know we had a couple interviews. I think one of them was back in March of last year, and the conclusion I had then is still the conclusion I have now, and that is that we would see no major crude recovery for at least 1 to 2 years, and that I think there certainly is that key level to watch around $55 to $60 a barrel, and there's key fundamental reasons for that too. And if you look at the fundamentals that spurred the crash in crude, obviously there was overproduction and demand starting to slack, and then dollar rallying, but at the same time, Saudi Arabia made it clear that for once they were not going to step in and say or do anything during that 2014-2015 crash that would even hint of production cuts or anything that would support the market, which, you obviously ask the question why, and there's some obvious answers to that too, and one is the domestic or American fracking and shale industry that was becoming more and more of a competitor there. But I think the numbers are still around $60 a barrel, where it's profitable for fracking, and so just by coincidence, we've been under $60 a barrel, and every time it starts to head back up there, something comes out to slam it again. The last time that there was a weekly close above $60 a barrel was back in December of 2014. And crude continued to sell off from there. It set an initial bottom I think I just said December 2015, December 2014. Crude set an initial low in January of 2015, then it rebounded, and where did it stop? Right at $60 a barrel, got hammered again for the next 10 to 11 months, dropped into January of 2016, and since then has been struggling to recover, and we got up to about 55 or so in January, February of this year. And now it's starting to roll over, and what comes out, but the Saudis admit that, those cuts that we said back in the end of November, well, we didn't stick to them exactly. About a third of what we said we were going to do, we didn't actually do. And so it's it's hard to ignore the coincidence between any time crude gets near $60 a barrel and something coming out that slams it down again, so that you have, that much more of a strain on the U.S. oil industry. And, it takes a couple of years to really, those ramifications to play out through the industry to where you start to get a reconsideration and reallocation of resources, to where U.S. production starts to tail off, and it's not something that you can start back up with the flip of a switch. So, if there is a competitive thing really triggering a lot of this, you wait till your competitor finally throws in the towel, and then all of a sudden you cut production.
Why is it that we need these major events to bring the price down?
I think it's as much perception as anything. And, when you had the crash in oil, just like any market that's either crashing or going parabolic to the upside, it always overshoots the equilibrium point or the balance point. And so if crude really, based on supply and demand, should be around $50 a barrel, then when it was crashing and got down in the mid to upper 20s in January of 2016, it had significantly overshot that equilibrium point. And so then you kind of get that snapback. And so that becomes a critical resistance point. But as the market approaches that, I think that, if it is an intentional thing to keep a lid on prices, then obviously you don't want psychology to get too bullish, because if crude started breaking above $60 a barrel, you might get that kind of momentum that feeds on itself, and then it gets a little bit out of your control. So each time you're getting close to that, rather than rolling the dice, you just you come out with some announcement or some revelation that's going to keep that price suppressed. I mean, that's just again, I don't think it's anything that's rocket science, and if you look at it as a competitive thing, which it is, any of these things in the market are competitive. They don't have to even be taken to the level of some nefarious survival of the fittest type of death struggle. It's competition, and if Middle East production wants a bigger portion of the market and sees the American production coming on strong and creating a threat to that, so you do what's in your power to combat that threat, and see how the American production and other related production responds to that.
We'll have more with Eric Hadik right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Eric Hadik. Eric, it was Saudi Arabia that pushed for this controlled oil production freeze, and yet they're the ones who seem to be the biggest violators of it. Any surprise there?
I think it certainly is a little bit of a shift from years gone by, but I think it's kind of consistent with what you saw in 2014, 2015. To some degree, it's Saudi Arabia saying, no, we're not going to be the ones that undertake all the sacrifice, and we lose out on a lot of income while everyone else benefits from the rising prices as a result of the production cuts. And they're just not looking to be the only one taking the big hit. The other thing that, and I talked about this back in November, that I thought was very intriguing, almost comical, that you watch the production in Russia, and it had been escalating, and they finally, in September, October, and I think November, were hitting record production levels. I'm not sure how close to capacity it was. But then when they finally get to that, then they say, yes, let's talk about a freeze. Well, they've just gone to the upper extremes of their capacity, where who's to say how much more they could even do. So then all of a sudden they start talking, yeah, let's all freeze our production here. We're good where we're at. So, anyone else that maybe has been restricting production or has had issues geopolitically that have curtailed production, we should all agree to a freeze here. And you had Saudi Arabia at the same time talking about a bit of a cut, but also at the same time you had Iran just coming back online due to years of sanctions being lifted and making it clear that they had a lot of catching up to do, so they were going to be ramping up production for months to come. And, everyone kind of said, oh, okay, I guess we have to appease that and give in to that. So you've got the headlines hitting the media about production freezes and maybe a little bit of a cut, relatively speaking, but at the same time you have Iran's production ramping up throughout that whole period. It basically is a wash. And so anything that was stated in November as being a big support for prices really was just creating a bit of a dead cat bounce. So what you're seeing is no surprise, even from a cyclic perspective. Since December, I kept talking about February 20th to the 24th as being the timing for a final high in this upcycle, and that from there we should see another downturn, which I think should last into probably early May. But there's an even more significant time frame a little farther out in this year that I'm starting to discuss and elaborate on, that I think that's going to be the real key. But you had all these cycles saying that after February 20th to the 24th, we enter a new down phase, and crude rebounded into February 21st. Heating oil and gas kind of struggled at that point, and once we got through that cycle, all of a sudden you saw capitulation start coming into the markets. But it wasn't until a couple weeks of that. First you had heating oil turn its weekly trend down. That's a specific indicator that I use that's more of a confirming indicator. And then unleaded gas joined the party and turned its weekly trend down, and that indicator confirms that a multi-month peak has taken hold, and we've entered a new 2 to 3 month or longer down phase. And finally, crude did the same thing last week. And so it's just all, the charts were already showing that some of this topping phase was in place. and then you get the fundamental announcement to corroborate that, which is usually how things play out. They show up in the markets long before they hit the headlines, and when they hit the headlines, often the biggest part of the move is already over.
We'll have more with Eric Hadik right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Eric Hadik. Eric, you say there's some kind of panic or confusion among people who were interested in gold stocks.
Well, I think the biggest confusion that I've referred to many times is that that thinking that there's a direct one-to-one correlation between what bullion prices of gold and silver are doing and what the prices of gold stocks are doing, and nothing could be farther from the truth. That, the price of bullion is certainly an important factor in the pricing of gold stocks and mining shares, but there are many other factors that often outweigh or at least severely dilute price swings in gold and silver. And I really tie it all the way back to a critical axiom of trading that I describe in my trading manual. And very simply, I just call it the axiom of market correlation. And it's this principle that I see reaffirmed and reaffirmed month in and month out. And that is that when you're looking for a correlation between certain markets, and that could be, say, interest rates versus the stock market, or it could be inflation versus gold and silver. And many of those corresponding markets, they will have a direct correlation only during the really accelerated moves, during the parabolic phases of a trend. And those accelerated moves usually only happen 15 to 20% of the time. So when, the dollar bottomed in 2008, then it set a secondary bottom in 2011, then it set a bit of a higher bottom in 2014. Meanwhile, crude was bouncing around near highs between 2011 and 2014. But all of a sudden, the dollar went into a very strong phase during 2014 and into early 2015. And now all of a sudden, markets like crude and a lot of your commodities and even a final phase in gold and silver, all of a sudden now they pay much closer attention and they're more directly correlated to that, in this case an inverse correlation, but very strongly correlated to that move in the dollar. And so the dollar rallies strongly, accelerates higher, all these other markets accelerate lower. Then you enter a more sideways trading phase. Well, if you're trying to look at that correlation day to day and week to week, and anytime the dollar's up, you're looking for crude or gold or commodities to be down, that correlation goes out the window. And you're lucky if it's right 50% of the time, so you might as well flip a coin. It's because there's all the other factors that influence that market that now start to become more significant and a higher proportion of what is valuing that market. Taking that description, that analogy back to the discussion on gold and gold stocks, it's the same thing. when gold and silver are having an accelerated move to the upside or the downside, yes, the gold stocks follow in close lockstep to that. But as soon as you exit that accelerated move, all of a sudden now the day-to-day swings and the week-to-week swings in gold and silver play a severely diminished role in the value of those gold stocks. And so like a little over a month ago, and I think we discussed this in a couple of our last interviews, all of my work was saying that the gold stocks were peaking on February 8th to the 10th. And I put out an alert on February 8th titled that the gold stocks were at an intermediate cycle high. And I spent a few pages describing all of the factors that were saying February 8th to 9th should be the top in this rebound from the December lows, and that gold stocks should now head back to those December lows and probably drop below them, even though the bullion prices had some remaining strength, and on a cyclic basis, they shouldn't turn back down until early March. And then when they drop, I expect them to bottom out above the December highs, so creating some divergence there where you have higher lows in gold and silver but lower lows in gold shares. And so really the gold stocks saw some of their sharpest drops in that 2 to 3 week period after February 8th, even as gold and silver were edging higher. Then you finally get gold and silver coming to the end of their cyclic up phase and starting to turn down in early March, and that triggers the next phase of the decline in gold stocks. But during, if you said over the last 30 days and took each week or even each day and tried to find a consistent correlation between the day-to-day swings in gold and silver versus the day-to-day swings in the shares, again, you're back to at best a 50% correlation, and no matter how many times that happens, it seems like you still hear from the gold bugs that are talking about how the shares just have to escalate, have to take off. But, that's not really factoring in all of the other considerations of a stock value, from corporate governance to expenses to, just how the company is run. And none of that impacts the price of bullion. So it's more common sense to expect some divergence, except when you have that accelerated move going on.
Eric, thank you so much for speaking with us.
Thanks for having me back, Jim. It's my pleasure.
My guest has been Eric Hadik, president of InsideTrack.com, Inside spelled INSIIDE. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.